Futures higher after a big margin surprise from Tesla. 30 minutes until the start of cash trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, Southwest gets a needed boost in third quarter profits as it tries to fend off a fight with activist investor Elliott Management.
And Tesla delivers a blowout quarter, forecasts strong sales growth for next year as well.
And no dice. Boeing workers reject a new labor contract that would have increased their wages by 35% over 4 years. We'll have all the details and more, but let's take a look at where markets are trading right now because, boy, we are ripping, at least relative to the last couple days on the S&P 500, looking to snap a 3-day losing streak. And bulls have Elon Musk to thank for that. Of course, Tesla shares currently up about 14% pre-market. That's what you're seeing in the NASDAQ 100 as well. Your big tech index up about 0.8%. And even the bond market is behaving relatively. You do have yields a little bit lower right now to the tune of about 3 basis points, Matt, but still pretty elevated when it comes to the absolute level of the 10-year Treasury.
Yeah, and those gains could be despite or because of the miss on unemployment claims. It was higher than we anticipated. Nonetheless, the economic data has been surprising to the upside. The white line here shows all economic data, even though the beige book seemed like a bummer. The blue line is labor economic data. Still surprising to the upside, but going flat with the jobless claims this morning.
Where else we have some upside surprises, of course, is in the equity market. We're going to watch a couple of stocks here. Tesla, big surprise, up more than 14% pre-market. We mentioned the blowout quarter. It led the company to forecast up to 30% sales growth for 2025. And UPS shares, on the other hand, also higher by more than 9.8, almost 10%, after returning to sales and profit growth for the first time in nearly 2 years. And American Airlines said that full-year profit should top analyst expectations, a sign that the pivot from a failed sales strategy is gaining traction. You have it up, though, only less than 0.2%, Matt, but still some green on the screen.
All right, we will continue to follow all the earnings out this morning. Earnings season getting busier and busier. And I was listening to you and that other guy on Bloomberg Business Week.
I think his name is Tim.
Tim Stenovec yesterday on Bloomberg Business Week. I was really surprised with Tesla, especially the margins. We were looking for like 17%. They've been coming down. They posted 19% and change in margins. That's a good sign.
It's funny because, of course, you drumbeat to the earnings, and it was a pretty down-and-out drumbeat because Tesla shares have had a really rough ride. But a real surprise here, I mean, when it comes to the actual results that they posted, also that upbeat outlook from Elon Musk. Of course, a lot of people pinning their hopes on that. He was pretty casual about it, though. He said something like 20 to 30% growth next year is his best guess.
That's huge.
That's huge. But again, you know, not exactly very formal there.
Now, if you think Tesla is part of the Trump trade, then do you think that the stock is rising more or less than if we had been not just 2 weeks from an election at this point in time? So you have to wonder if there's more where that came from.
Well, exactly, because you could see a positive for Musk if Trump takes him into the cabinet, but maybe, as Tim pointed out, a negative for consumers, right? Not all like electric car buyers are huge Trump fans.
You also have to think about Elon Musk's divided attention. It's been a topic for a while. He has his hand in 6 different companies, but if he's in the government, I don't think he's necessarily concerned about the day-to-day of Tesla.
And honestly, real quick note, too, there's a lot of other promising data in the earnings, right? I mean, you're talking about the airlines all morning, and it is true that was a big trade that a lot of investors were waiting for a better comeback.
Right. I'm focused pretty solely on Tesla. That's not true. I'm looking at Hog as well. Bit of a disappointment from Harley Davidson. But let's talk about the bigger picture stuff right now with Morgan Stanley Senior Portfolio Manager Andrew Slimman. Andrew, everybody was waiting for, you know, as Katie said, drumbeat to Tesla earnings yesterday, and they really knocked it out of the park. But is it a proxy for big tech? I mean, is a car maker really a good signal for technology stocks?
I don't think so, which is not to say I think these companies are going to have very good quarters, but I wouldn't necessarily assume Tesla, so goes Tesla, goes the rest of the tech companies. But I will say this about Tesla. He does seem to love to surprise on the upside and downside. You know, don't forget, It was less than 2 weeks ago. He kind of disappointed on the rollout. Comes back with a great quarter. It's a
The
very
rollout of the robo-taxi, right?
Exactly.
Which was a big ho-hum.
Andrew, you know, the reality is we are really just getting started with earnings season. Yes, there was a lot to love with Tesla, but next week is the really big week. And if you don't think that the Tesla earnings say much about big tech, how do you position for the rest of big tech?
Well, you get nervous. This is the anxious time. You know, these quarters get me nervous when there's big reactions, but I see no reason to think it won't be solid quarters, primarily because I think you would get indications leading up to it. But there will be volatility. But what I really focus on this time of year, and it's really important, is how will that impact next year's earnings? If you look at what's interesting about stock prices, they actually, yes, short term, they move on what happens in the quarter, but longer term, they move on revisions, not for the current year, but for next year. And I think that's because the market knows that the companies play games and they talk down their earnings right before quarters so then they can beat it. So there's a lot of gamesmanship, but what does it mean for out earnings? That's what is key. So I'm very focused on right now, consensus for next year is 275, 276, bottoms up. Will that number go up or down after the quarter? I think that will determine where the S&P ends this year, because don't forget, when we get to the end of this year, next 4 quarters will be next year's earnings.
Yeah, and even if you can't extrapolate much from Tesla to the rest of big tech, you do have an interesting dichotomy right now between old tech, I'm talking about IBM having a terrible morning, and of course what's going on with Tesla. But Andrew, I actually want to get your thoughts on sort of the cross-asset relationships in this market right now, because you point out in your note that we do have much higher yields. They're starting to create an attractive alternative to stocks. And we know that high yields, at least according to the textbooks, are supposed to be bad for stocks when you think about DCF models, et cetera. But it seems like just when you're sizing up the relative valuations here, that bonds look pretty good.
Well, DCF is a the point you mentioned about DCF, this discounted cash flow type situations. When the Fed, if you go back to July 9th, when the Fed said, okay, we're going to be cutting in the future, all stocks that really priced off what's called the DCF model, which is I take the risk-free, I look at future earnings and I discount it back using some type of DCF, those types of stocks took off. So in other words, small cap, companies that have fast growth rate, and then you use a risk-free rate because yields came down. And so those stocks did very, very well. But the problem is now yields have reverted. So suddenly maybe people's DCF models are wrong and the risk-free rate is higher. So I think that's going to weigh on stocks, small cap, or some of the more cyclical stocks that are more geared to lower rates. And that's what's really worked until just recently.
I mean, we're looking at a 10-year yield right now, 420, 421. A lot of talk on this program, and I know a lot of talk in your office as well about when or how to move cash out of money markets, what to do with it after. Do you really want to, if you're worried that we could see rates rise, we could see tariffs, which are perceived as inflationary by a large part of the population? I mean, do you leave some there? Do you need some dry powder for post-election?
Matt, it is, when I talk to financial advisors and invest in our funds, it is the number one. I get this every day. Hey, I have clients that were content with 5% in money markets or 1 year, can't get them out. What are we going to do? They're going to want to get more invested if rates come down. When is a pullback coming so that I can get them invested? I hear that every day, and I'm not sure at this time of year you're going to get much of a pullback. Now, you've heard all the statistics. Lower yields doesn't spur people out of money markets. But when you get lower yields and FOMO, right? We've now had 2 years of a bull market. That will spur money to come out. So I do think that if the Fed is on this path, and granted rates have gone up recently, but if they're on this path, I think that once we get through the election, we get into next year, I think that will cause people to push money into equities as much, in addition to other things as well. And that will continue the bull market, at least for the first part of next year. I am worried about kind of cap gains sunsetting second half, but I think that FOMO is still out there.
And certainly that next Fed meeting, just 2 days after that election. Morgan Stanley's Andrew Sliman, we thank you for joining us here today. And another story we're watching this morning, of course, is Boeing, because a big surprise to many investors, the labor strike continues after factory workers rejected the latest contract offer. It would have increased their wages by 35% over the next 4 years, and the strike is impacting production on a number of models for over a month. Joining us with more is Benedict Kamel, who leads Bloomberg's global aviation coverage. And let's talk about what's at stake now for Boeing, because a lot of investors really did underestimate this. They thought it was in the bag, but 64% had voted against. So what kind of hurdle does that create for Boeing?
Yeah, that's still a really sizable hurdle for the company. Now, if you look at this optimistically, you could say, well, 64 is a lot better than the 94 that we had in the first vote in September. So you have more people moving over to the other side, to the let's accept this side. But we're still somewhat off from the 50% acceptance that they really need. So for Boeing, it's back to the drawing board. They have to reconfigure their offer that's out there. You said it, 35% on the wages. They have a signing bonus, $7,000. They're putting some money into the retirement, and those are the areas that they'll need to work around. It's probably not so much on the wage side where the conflict resides. It's more on the pension and the retirement side. So that's the part that Boeing needs to take a hard look at. The workers want their old pension systems reinstated, and Boeing says that's not going to happen. That's our red line. But the real question is, how much movement can there be? How much elasticity is there in that red line? Because every week, every month, this strike drones on. It's going to cost them dearly. We heard from the CEO yesterday that essentially this year, in terms of cash, is a write-off. It's going to be a cash outflow year. And surprisingly, I think for a lot of people, the first half of next year will also be a cash out year. So those are some really bad numbers from Boeing and bad predictions.
So a precarious position for Boeing. And as you point out, I mean, the pension issue, there's still a lot of daylight between these two sides. Let's talk about the ripple effects here, because, of course, we are in the heart of earnings season. We heard from American earlier today, and their CEO saying that we need them to deliver quality aircraft on time. I look forward to the phone call when Boeing says we're able to do so. And I mean, it's been discussed before. You really only have two options, Airbus or Boeing. So they have a loyal customer base here. But I mean, these airlines have to be getting fed up.
You're absolutely right, and this is a huge issue that's across the industry, and every airline you speak to, they say, where are my planes, where are my new aircraft? I'm forced to either reduce some of the routes that I have, I'm forced to take some planes out, and that's causing huge disruption at a time when travel is still out there. Right now, Boeing is almost producing no planes. They are making 4 aircraft a month. This is one half of the duopoly making 4 planes a month, 1 a week, just to give you a sense of just how little they're producing. Airbus obviously have issues of their own, but they are at least producing. And this is something that over time, it's not going to happen overnight, but over time can really start tipping the scale between this duopoly and turn it more into 60-40, maybe even 70-30 type sort of balance. And that's something that Boeing really needs to watch very closely.
All right, looks like, especially since they have about $60 billion in debt with the BBB- rating, they have to be pretty careful. Definitely fixed income investors to be careful there. Benny, thanks so much for joining us. Bloomberg's Benedict Campbell, he runs airline coverage for us globally, sitting in the London office today. Coming up, we're going to switch gears and talk Tesla. The stock is soaring after a blowout quarter. We'll take a look under the hood next. There's a frunk. There's a frunk in a Tesla. This is Bloomberg. Tesla shares are soaring pre-market. The automaker's third quarter results blew past estimates and posted a strong forecast for 2025, as casual as it may have been. The results were lifted by the Cybertruck. It is now contributing to profit for the first time. It had been a losing proposition for the company. Joining us now is Vijay Rakesh, Mizuho Securities Semiconductors and Automotive Tech Senior Analyst. He has a neutral rating on the stock with a $230 price target. And first off, Vijay, I think it's awesome that there's a semiconductors and automotive analyst in one job because, you know, increasingly you need thousands and thousands of chips in each of these vehicles. What do you think about Tesla's earnings?
Yeah, absolutely. Thanks for having me on, Matt. I think the confluence of semiconductors and automotive is very obvious across the spectrum. More and more we see semiconductors melding more into the automotive side. But I would say, looking at Tesla, very solid quarter here, especially on the profitability side. The margins were definitely a standout, up 200 bips sequentially. But the question would be, looking out, is how sustainable those margins are, because the CFO did say on the call that the margins at these levels might not be sustainable. They also have had a pretty good FSD contribution to the margins. Almost half of the pickup on margins were from the FSD side. So maybe that comes down going into the December quarter as well. So something to watch. But we think there could be some challenges going to December quarter here.
So want to know how much more juice there is in this stock, because if you take a look, the price this morning into the early trade was about 243. That is 71% higher than the lows of this year. And if you think that there could still be margin pressure ahead, is this move warranted or overdone?
Yeah, I think what we see is on the guide for the December quarter or for the full year, they're looking at now units flat year on year. That would imply a pretty significant pickup into the December quarter, almost like 12% sequential increase in deliveries. That's the biggest quarter that they're probably seen. So we think there could be some challenges there, given that the European Union is now looking at putting tariffs on Tesla imports from China. You have the Cybertruck deliveries now, where they're now giving a $20,000 promotion on the Cybertruck as well. So you're seeing some challenges as you go into Q4 with that. And looking out to 2025, as you were talking before, a pretty solid 20 to 30% increase in deliveries. That would be an incremental 500,000 units for next year, which could be, given that we still haven't seen what a low-cost EV from Tesla looks like, could have some investors scratching their heads. So.
Well, that's where I want to go, whether or not that 20 to 30% next year growth is realistic, because you think about all the reasons why Tesla stock has had such a rough year. Of course, you have an unclear roadmap when it comes to those low-cost EVs. Elon Musk is clearly very dedicated to betting the house on autonomous vehicles. And then you have the fact that for all automakers, EV demand is slowing. And when you add that all together, does 20 to 30% sounds like something that Tesla can actually achieve here?
No, look, I think Elon Musk and Tesla have done an exemplary job. I think they have really shown how good profitability they can deliver on the EV side. But there are still challenges in terms of EV sales. And so we think 20 to 30 might be a slightly high bar, given that we still don't have an EV, what a profile of an EV, low-cost EV car looks like. And also, as you look at next year, there are still challenges with high EV penetration. In the U.S., still challenges with EV penetration in the U.S. And in Europe also, what we are seeing is year-to-date, EV sales are down 5% year-to-date, year-on-year, which is pretty significant. So I think that number could be a little bit challenging as you look at 2025.
I mean, I think they already have a low-cost EV, right? The Model Y, you can pick it up for 34 grand new. And if you just look for a one-year-old with low miles, you're going to get down to the high 20s. So I can't believe they're going to be able to boost sales by 30% next year. That seems pretty punchy, Vijay. What are the chances?
We'll see. I think at this point we have to take what Musk and Tesla is saying. So, depending on when they launch it, what the size of the launch is, what the price points are, the market definitely needs something in the $25,000 range. We don't have that out there yet. The bigger question beyond that is, how profitable is it? Can they make it with sustaining the margins that they have here? We think that could be a little bit of a challenge as well.
Vijay, we thank you so much. Of course, it's a hot stock to watch today. That is Vijay Rakesh of Mizuho Securities. Now, coming up, not riding so high on the hog. Sorry, Matthew Miller. Harley Davidson selling fewer motorcycles. You got to get on it. Details up next in Social Climbers. This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, McDonald's supplier Taylor Farms is recalling some yellow onion batches produced in a Colorado facility in response to that deadly E. coli outbreak at the fast food giant. Taylor Farms said it hasn't found traces of E. coli yet, but decided to pull back the products out of an abundance of caution. Next up, we have T-Mobile reporting third quarter results that beat expectations. It also raised its full year forecast for subscribers. T-Mobile was the only one of the big three telecom companies to beat analysts' forecasts. It has also been more optimistic than its rivals about demand for the latest iPhone. And finally, we end with Harley-Davidson. It's cutting its full year revenue forecast thanks to lower overall demand and fewer sales of its higher margin bikes. The CEO blamed high interest rates along with broader uncertainty about the economy for the weak results, but said he was optimistic about a better 2025. Shares still down about 1.2%, Matt Miller. And I thought this was interesting solely because I like the ticker. It's HOG.
HOG, yeah, and it used to say oink on the on the trading page as well. You know, they're charging $45,000 for a CVO Road Glide, which is, to be fair, it's a lot of bike, but that's a pretty decent car for that price.
I was going to say, what kind of car would be comparable to that motorbike at that price?
I mean, it's an awesome motorcycle, so I think it's
car?
better than almost any car. But yeah, for 45 grand, you can buy
2 to 3 horses. Pretty good ones,
yes,
too.
Good horses,
Yeah.
and a lot of cowboy boots or handbags or whatever Shanali's focused on. Coming up, less than 4 minutes until the opening bell. We'll discuss the moves with Tracy McMillian of Wells Fargo Investment Institute. We could have a recovery today, folks. This is Bloomberg. All right, we could see a turnaround today after 2 down days. Wait, was it 3?
It was 3.
3 down days. Oh my goodness. And futures are up right now. 1/3% on the S&P. NASDAQ futures up 0.75%. Tesla really blowing away expectations, beating on margins, which I thought was a huge deal. And then saying next year, maybe 20 to 30% sales growth. That's crazy talk. Here the opening bell on the New York Stock Exchange. You got Ingram Micro ringing the bell there, and it worked today, which is great. Hoo-hoo Tech ringing the bell down on the NASDAQ. No idea what they do, but what an awesome name. In terms of where the indexes are moving in the first 20 seconds of trading, let's get over to Katie Greifeld, and she can tell us. Katie?
All right, 23 seconds in. We have green across the board. A very different picture from where we were just 24 hours ago. We had 3 days of losses on the S&P 500. Big tech has been relatively resilient, actually only 1 day of losses, and that was yesterday. Today, totally different story, and that's thanks to Tesla, which we'll get to in a second. But you can see big tech leading the way. Small caps, though, also putting up a fight here. The Russell 2000 up about 0.3%. But of course, the story is Tesla. Shares really surging after a strong earnings report and a forecast from Elon Musk, a casual forecast, 20 to 30% growth in vehicle sales next year. The Cybertruck contributing as well for the first time. Shares currently higher by about 14%, Shanali.
And Katie, not every story is an up arrow story. There certainly are a lot of them, but I'm keeping an eye here on IBM. Shares are down after earnings to the tune of about 6% nearly. Analysts are noting that weaknesses in the company's consulting and infrastructure businesses weighed on results. Matt, it's a bit of a bellwether here for business spend moving forward.
Yeah, absolutely. Based in Armonk, just a few short miles from me. The Boeing union representing the 33,000 striking workers rejected a new labor contract. It would have increased their wages by 35% over 4 years, but there's a sticking point in that they want defined benefit pensions as well. We also had a lot of airline earnings out, closely connected, obviously, the plane maker. Let's get the details of Bloomberg's Abigail Doolittle. Abby?
Well, we have a little bit of a mixed story here, or at least mixed market action for the shares of American Airlines versus Southwest Airlines. Americans up about 5.1%. They did boost their profit outlook despite higher costs, but they've really gone after a new strategy, let go of that old strategy around business travel, and they're aggressively going after the new strategy. Apparently, it's working. Southwest Airlines beat, but in terms of their guidance for the future quarter, it points to higher costs, so investors not liking that, sending those shares lower. Both of these airlines, relative to the amount of revenue that they're making per seat mile, you can see that prior to the pandemic, pretty steady in this midline range, and then around the pandemic going down in a big way. In 2022 to early 2023, higher and now lower. So these airlines really trying to squeeze out that revenue per seat. Let's see whether or not they can get it back to the upside. Speaking of the pandemic, not surprisingly, these stocks still down over that time period or over the last 5 years. American Airlines, Southwest Airlines, and then the overall composite all down more than 20%. Lots of ground to still make back, Katie.
Abigail Doolittle, thank you. We should also mention UPS having a fantastic day. Of course, UPS rallying in a big way, jumping 10% at one point. That was the biggest one-day gain since February 2022, holding those gains now. Of course, UPS reporting that revenue beat forecasts for the first time in 2 years. Of course, this is a stock that needed it, down more than 13% year-to-date into yesterday's close. We'll unpack those results in about a half an hour or so. But let's discuss the broader market now with Tracy McMillian. She is Wells Fargo Investment Institute Head of Global Asset Allocation Strategy. Tracy, it's great to have you with us, of course, in the thick of earnings season with a lot more still to come here. It's early, but what do you make of the results so far? Because it's been really, hot and cold when it comes to these market reactions.
You're right, Katie. It has been hot and cold in terms of the reactions. And, we're expecting a fairly modest earnings season here. The consensus is around 3.4% earnings growth this quarter. It'll probably come in better than that. We usually do see better earnings than the consensus numbers. But what's most important is probably how companies are guiding. And if they're guiding up in this market, especially like some of the big companies that we've seen reporting recently, then that's telling investors that it is okay to continue to invest in a lot of these themes that have been driving the markets through 2024.
How much of the higher guidance, Tracy, is contingent on the Fed continuing to cut rates? I definitely saw Harley Davidson, Jochen Seitz, the CEO there, saying rates have been killing us. I'm paraphrasing. But we expect them to come down next year, and that could boost sales. Elon Musk saying maybe 20 to 30%, but it was a very casual mention. Doesn't seem like he's studied it that closely. I guess he could say he lives it. Do we need rates to come down substantially for this kind of earnings growth to continue?
Matt, both of those companies that you mentioned are dependent on lower interest rates and dependent on credit. And so they probably are factoring in lower interest rates into 2025. And indeed, we do think that the Federal Reserve will cut rates by 50 basis points more this year, another 75 basis points next year. We do see the economy slowing down a bit, giving them that opportunity to cut rates. So that forecast is actually in alignment with what we're seeing right now. Should the economy stay stronger and the Fed doesn't cut rates as much, then those companies could still benefit because the economy is growing at a stronger clip than we're currently expecting.
When we think about the economy, you had the jobless claims this morning coming in better than expected. You're looking at these earnings. You're seeing UPS volumes looking better. You're seeing the airlines doing pretty well. And you have the consumer discretionary index still lagging the broader S&P 500, but really catching a bid in the market. Something just pointing out that's interesting today, you did not see the trade really follow through yet. You don't see the cruise lines up today, even with Royal Caribbean being your best performer in that index this year. At what point do you still get cautious here for that trade around the consumer? Do you think it's ready to take off in a bigger way?
So not necessarily. We continue to have consumer discretionary as a neutral weighting in our portfolios, and then those more defensive sectors as underweights in the portfolio. So we do think that what we're going to see going forward is more of a continuation of what we've seen those upper quintiles of the consumer continuing to do well, continuing to spend, companies continuing to spend around the AI build out of that infrastructure. And so that is what is probably going to propel the economy in 2025. And so we're focused more on the cyclical areas of the market. So, think those types of businesses that are going to benefit from those conditions. So those are going to be energy, financial, industrial, and communication services.
Tracy, thanks so much for joining us. Unfortunately, we're having some technical difficulties here. You're breaking up a little bit. So we're going to try and get back in touch with you as soon as possible, get you back on the program. Tracy McMillian there from the Wells Fargo Investment Institute talking to us about these markets and a little bit of a comeback today. I mean, we had 3 down days in a row.
On the S&P.
On the S&P, you watch other indexes more closely?
The NASDAQ, I cast my eyes over there every once in a while.
Right, so what, tech was doing better than?
Tech managed to hold up the first 2 days of this week. Yesterday, obviously, was a big ouch. Today is a big win. We'll see if it holds, of course. We're already off those pre-market levels. It's too bad we were having technical problems with Tracy because I think it's an interesting question. I mean, are you playing defense in this market? Are you holding chips through the end of this year? Or where can you play offense right now? I mean, it seems like a lot of people here are happy to just hold on through the end of the year.
Yeah, to that end also, it's like, when do some of these trades that are still a little risky, when do they take off? I was looking at some of the biggest movers in the S&P. Another one besides Tesla is Pool Corp. Pool makes stuff for, as you would imagine, your backyard pool.
And summer, right? I mean, it's really, it's time to close the pool right now if you haven't already.
Totally. And anyways,
has a lot of leaves in it.
Yeah.
It all goes to say that people are spending money, maybe not on Harley Davidsons right now, but elsewhere, Matt. Anyways, coming up, we're going to talk about Verizon. It is no longer a buy after lackluster earnings this week. More from today's top calls. This is Bloomberg.
All right, it's time now for our top calls. Some of the analyst action in focus this morning, and we start with KeyBank, saying that Verizon is no longer a buy. It's downgrading the stock to neutral following the company's results. The analyst says there's little room for earnings acceleration next year. Next up, KGI Securities raising Tesla to a buy after that EV maker reported earnings that topped estimates. Of course, more good news for Tesla, shares up 16%. And finally, we have JP Morgan downgrading Avery Dennison, saying that the label maker is no longer a buy and cutting its price target by $20. That's after the company missed third quarter earnings estimates, Matt.
All right, so labels, I guess, aren't very popular right now. I'll try and do something about that afterward. Turning to the fall meeting of the World Bank Group and the IMF in D.C., Bloomberg's Lisa Abramowitz joins us, and she's got the governor of the Bank of Israel with us. Lisa, take it off.
Thank you so much. I am here with Amir Yaron. He is the governor of the Bank of Israel, and he joins us here on set. Governor, thank you so much for being with us. I want to start with this idea that everyone here is talking about inflation and growth and trying not to talk about a U.S. election. But then, there is sort of a question of how do you come up with ranges of estimates for growth, for inflation, when you're mired in a war?
Lisa, first, thank you for having me. First, maybe a little background. Before the war, Israel was on a super softish landing, high growth. Inflation was coming to the target, low debt to GDP. Israel also has a good record of coming out of security events, part of our resiliency and dynamism of the economy. Now, when you build up forecast in a situation that is mired with uncertainties, you kind of have to come up with basic scenarios. Obviously, the war has gone longer than initially anticipated. Right now, our basic forecast and scenario is that the war will continue roughly until into the first quarter of 2025, with an intensity sort of like what we're seeing now for another month or so, and then slowly take a notch down. Now, the critical parameters when you do this, and that's what we've learned, is What is the intensity of fighting and the number of reserves? Is the educational system open or not? We saw that was critical at the first month in October when missiles were flying around. We see a little bit of that in the north part right now. And obviously areas where there's limited activity. Those are key parameters for growth. There's I gave you kind of the basic scenario. Of course, there are alternative scenarios where the war goes on for longer. There are alternative scenarios where there may be even more intense.
Well, how hard is it to attract foreign investment at a time when there is this range of outcomes that's very wide?
I would say one thing, given clearly this war is of different scope in terms of duration and its scope, and yet when you look at the Israeli economy, it is showing a lot of resiliency. First of all, our external position is extremely sound. Our current account is still growing. We are seeing the shekel being volatile between 3.6 and 3.8, primarily due to geopolitical events, but still, given the scope of events, it is very. I would say it's. Some people would have thought maybe it would be moving even more, and so that shows a lot of confidence. I would say people are buying houses. That is the most illiquid asset you could think of, and Israelis are buying houses. House prices have come back to go up. So those we're seeing exports. The high-tech sector, for example, we are seeing in Q2 and Q3. Some of the VC funding has gone up. The services, export services of the high-tech sector have in fact been coming up.
So at a certain point, you have to wonder if this goes on for longer than your baseline, there is the fear that some of that could start drying up. At what point does the economic concern factor into the political one of how long to go, how far to escalate?
I want to make the point that obviously a flourishing economy needs security, and that is essential. On the other hand, security needs a flourishing economy. They're intertwined. We have basically now a committee that is looking into longer range investments of how much the security forces will need to expand in terms of budget. That is obviously the fiscal issues is something that we need to deal with as the costs of the war have gone up, debt has gone up, and in 2024 the budget, the government did do the appropriate things and did fiscal adjustment on the order of 1% of GDP. There's a 2025 budget that is coming up. We at the bank basically have said that we need to do additional fiscal adjustment given the extra cost on the order of 1.5% of GDP. And that's how you basically, if you do those things, and that's very important they be done, you basically convey to the markets that you're continue to be fiscally responsible. You maintain and strengthen your credibility towards the markets.
Does it create a more difficult scenario when the Israeli credit rating was downgraded, and there is this fear that the borrowing costs are going to start going up? How much could you see borrowing costs rising? Is that a problem for you as you try to figure out all these budgetary concerns?
So some of the numbers I just given you incorporate already the higher borrowing cost scenarios whereby the cost of the war indeed go into Q1 25 and some extra expansion of long-term expansion of spending on security. Of course, if we end up with alternative scenarios where, and some of the borrowing costs have gone up, but they've been relatively stable. The institutional investment places in Israel, risk premium has come up, and the downgrades kind of at some point aligned closer to them. But in general, at least now we are seeing the government being able to fund its debt. The costs are somewhat higher, but I don't see the market is deep, and we see the coverage ratios in these things are quite are quite well. So I think the pertinent issue is to do these fiscal adjustment, maintain the credibility of the markets. If we can do also structural changes, those are big issues. For example, adding the taking out negative incentives to go to work by the ultra-Orthodox, drafting them, making sure we invest in infrastructure and education. Those are additional things that we would like to see happening with the fiscal adjustment and the budget.
Just 10 seconds. In other words, drafting Orthodox would be part of the fiscal adjustments that you think are necessary.
Well, I think there's one is an issue of equity and inequality, but clearly, you know, as we will need more reserves, we've put estimates that if we have to go where the military is saying that reserve duty will have to be many more days than what they do now, the draftees will have to do 36 months instead of where they were going 28. That will cost Israel like 0.5% of GDP per year. So we need to increase basically the participation there.
Governor, too short a time. Thank you so much for being with us. Governor Yaron, back to you, Matt.
Thank you.
Lisa, thanks very much. Lisa Abramos there with the Bank of Israel Governor Amir Yaron. Fascinating discussion, saying they'll have to maybe draft the Orthodox there in order to make up for a shortfall of draftees. Also saying that the war has gone on longer than had been expected, and now they see it going until at least the first quarter of next year. Still, Israelis are buying houses, and service exports are going up. So back here in the U.S., we've got a ton of earnings out this morning. We've been talking a lot about Tesla, obviously. Not too much about UPS.
Yeah.
They actually had really good earnings, but they've been doing so poorly.
I know. So the bar was low there. It is interesting that you're seeing FedEx shares get a little bit of a lift as well. FedEx shares up about 2%. UPS having its best day since, I think, February 2022. Southwest is fascinating, though, because they actually topped profit estimates. They also came to some sort of agreement with Elliott, but then you take a look at shares off by about 3%. Still some bad news in that report.
Fascinated by that agreement because they're giving up 6 board seats, but the CEO can keep his job for now. Anyways, we're going to turn now to the Wall Street Beat. We're going to talk about deals because that's another thing moving markets. Keurig Dr. Pepper will acquire Ghost for around $1 billion. Ghost sells energy drinks with flavors such as Sour Patch Kids and Warhead. That's pretty throwback, if you guys may remember those. Anyways, the Bloomberg's Liana Baker covers all things deal for us, leads the deals team out in the United States. Listen, 4% decline in Keurig shares, the biggest deal since they acquired Dr. Pepper. One thing that struck my eye about this was $1 billion in cash, cold hard cash.
But it is a two-step deal, so Dr. Pepper is going to pay, you know, a few $100 million or $990 million upfront, but then over many years, then they'll pay out the rest. So there is some downside protection here for Keurig Dr. Pepper, and the founders have to stay on, and they have to meet certain targets by 2027. Should they reach, you know, this valuation by the time the deal's up in 2028.
By the way, I was just, so Sour Patch Kids and Warheads, those are kids' candy flavors, right? In a drink that has 200 milligrams of caffeine per can.
Seems like a natural fit there.
Is it right to market that kind of drink at little kids?
Yeah, you can really like inject the caffeine into the children. But let's talk about the beverage industry. We actually had the CFO of Coca-Cola on yesterday. We asked him, are you looking for deals? He said he's open to it. Interesting to see this news then hit. And Matt, you were pointing out there's just so many energy drinks out there. This feels like a space.
Rockstar, Monster, A-Shock, Celsius, Red Bull.
Coca-Cola. So Coca-Cola has a big stake in Monster, and Pepsi actually has a stake in Celsius. So there's really a land grab with all of these faster growing energy drink in that category that, you know, the traditional beverage makers are going in and either buying them or taking stakes or partnerships.
So consumer deals, very interesting right now. Your team has been covering something else that has been absolutely fascinating. That is the desire of traditional way kind of companies to get more into technology. Want to point out this Siemens deal in talks to acquire a software group, Altair. This is a Michigan-based company looking to sell to a large German one, cross-border, more than $10 billion perhaps. What do we know?
So right now, the deal hasn't been announced yet, but we reported that Siemens is in advanced talks to buy Altair. The market cap right now of Altair is over $9 billion, so with a deal premium, you could see this over $10 billion. And Siemens for years has been trying to shift from their old line industrial business. They have bought software companies before. A few years ago, they bought something called Mentor Graphics, which actually competes a little bit with Altair. And we've just seen a lot, Siemens and its competitors looking at industrial software. This is how they modernize. This is not, internet software, anything like that. It's really software that helps them on the manufacturing line and in their plants and how they optimize that. And maybe there is an AI angle that makes, this trendy, but Altair makes more, manufacturing hardcore software to keep things running.
Oh, the software thing is just hard for me to wrap my head around. Energy drinks is much easier.
Yeah, I know. You can feel and touch
There are
them.
literally hundreds of brands, and at some point,
It's bigger money at play. It's about more than $10 billion.
there has to be more consolidation in this. I mean, Google AI tells me 500 new energy drinks were launched since 2006.
That's a lot. You can't imagine that all of them are going to survive. Liana, it's great to see you. Thank you. Of course, that is Liana Baker. A quick check on markets right now. Of course, we're still holding on to gains, but they're coming back a little bit, of course. You have the NASDAQ 100 still up by about 0.6%, 0.3 on the S&P 500. Coming up later, David Einhorn from Greenlight Capital. That's at 11:30 a.m. Eastern.
We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, markets today, all about the consumer. UPS sees profit growth for the first time in nearly 2 years.
Making Citi competitive again. We'll talk to David Livingstone, Citi Chief Client Officer, on the progress he's making.
And Serve Robotics launches a new delivery robot that could deliver food right to your doorstep, no matter where you live. We'll talk to the CEO in just a few minutes. Let's get a check on these markets, though. An interesting day. You do see gains, but tepid when you consider, of course, the rip-roaring rally that Tesla is having. You have the S&P 500 up about 0.3%. The NASDAQ 100 holding on to gains of about 0.6%. Of course, Tesla up almost 17% at this point. But some of your biggest weights to the downside are Apple, are IBM, and you can see that tug of war going on right now. A quick check on the bond market. Of course, 10-year yields relatively behaved right now, down about 1 to 2 basis points on your 10-year Treasury yield.
All right. I thought IBM, which you mentioned, was really interesting because they came out with earnings that were light on consulting revenue, right? Their traditional consulting customers are kind of getting eaten up by their AI consulting business, so it's sort of cannibalizing that. And I want to bring in a markets mind who's also an economist to maybe play around with that idea. Lauren Goodwin joins us, New York Life investments economist and chief market strategist. Lauren, great to have you on the program. The idea of AI, improving productivity, I get how that's going to work, but is it going to help corporate earnings? In the case of IBM, it seems to be a wash. What's your take on AI just in general when it comes to the market?
I think it's far too early to be expecting productivity improvement based on AI. And that's because we're really in the first early stages of the S-curve, the increase in productivity and really uptake of this technology. So we've seen gains in the semiconductor, the chip makers, that really the...
Wait, why is it an S-curve? Does it...
Yeah, can you walk us...
Does it start on the bottom?
Sure, let's go there. So if you can envision an S in your mind, think about being on the bottom of the S. The economy markets tend to roll along more or less the same way they do until there's an inflection point for change. And at that inflection point for change, like an invention or a new technology, you then see processes and investment strategy change very quickly, climbing the S-curve until it levels off somewhere new. We're only just in the beginning of the S-curve, where there's investment going into making the chips that will one day fuel the business use cases for AI. Companies are still testing how AI actually makes their people more productive. That doesn't mean that there isn't amazing opportunity related to AI. We've seen the AI growth spurt broaden from the semiconductor supply chain and into the energy and other infrastructure for AI. But we're not yet seeing that broaden into corporate use cases. So I think we're too early to say that any productivity improvements, and we are seeing some, they're just not about AI.
Okay, so the S-curve, we're going up like this, then we inflect, and then we go like this. But it sounds like what you're saying basically is that it's too early to necessarily pick winners here, that we're still in the picks and shovels stage.
That's exactly right. Too early to say that any improvements we're seeing in productivity are really about artificial intelligence specifically. Now, we are seeing what looks like improvements in productivity in the U.S. Data revisions over the past couple of months have shown higher GDP and downward revisions to labor. That means more GDP for less labor. It's more productive overall. But again, it's not related to AI. It's more related to more normal cyclical trends in economic activity in the labor market.
And speaking of more GDP, more growth, you looked at even just the IMF data and this upward revision to the United States. Things look pretty strong. Earnings look pretty strong. And I've been losing my mind every morning over the upper bound of the 10-year.
That's what it is lately.
Lately.
There are other things on different mornings. Yeah.
So, but lately. And so right now we're actually seeing a tiny little bit in the bond market. You're at 422 on that 10-year. But my question is, how far can we go? And what are the spillover effects to higher long-term rates?
We're going to find out pretty soon, potentially, how high the market can bear the 10-year. Typically, last couple of years, post-pandemic period, 5% has been the sort of the rate at which institutional investors globally just have to take a bite out of that 10-year yield. But what we're seeing here just in the last month is a bear steeper than the curve, meaning that the curve is steeper but at higher rate levels across the curve. Now, we could explain a higher short end of the curve because of an improving economic outlook, but that doesn't necessarily explain higher rates on the long end of the curve. So what we see happening there is an increase in the term premium. Investors want more compensation for risk, and what's changed in the last month? The odds of a sweep. And so the real risk to the long end of the curve in the near term is the idea that we could have more government spending, which is more growth, but also higher inflation and concern about Treasury supply globally.
I'm glad you made that point about bear steepening, of course. Rates are getting higher at the long end. The bond market is selling off. And I want to talk about why that's bad for the equity market. We were having this conversation with Andrew Sliman about an hour ago, actually. But when it comes to the competition between, of course, bonds, and also I'd lump in cash there as well, and stocks, I have to imagine that we're getting to the point where people are looking at that rate on long duration assets and saying, that looks pretty good.
The reason that long rates are challenging for the equity market really comes down to how equities are valued. When you have to borrow money in the capital markets and it's more expensive and there are, to your point, more alternatives for investors, it becomes a little more challenging to justify an equity allocation, especially at the valuations that we have today. Now, one thing I'll say is that when you have a growth and a profit backdrop like we do right now, the economy's been absorbing higher rates pretty well. The market's been absorbing higher rates pretty well. That's not to say that there aren't bumps, and I expect we'll continue to see them, but this is an economic backdrop that's relatively well sustained. The one thing that I will say with respect to the trade-off to cash is improvement in investor sentiment towards cash is really about the short end of the curve. It's really just what is the Fed doing? How is the Fed reacting? So volatility in the long end of the curve I see as less of a factor there.
We need, of course, lower rates because yesterday we had existing home sales out at a 14-year low, right? Harley-Davidson is selling fewer and fewer motorcycles because those buyers want to borrow, but rates are too high.
You know what? Corporate interest payments near record lows. Why can't someone get a mortgage, but corporations can borrow endlessly?
I think this is such an important question for where the economy will go from here, because it's one of really a lot of debate among our investors on our platform, this idea that historically when the Fed cuts rates, it improves housing, which improves construction and really provides somewhat of a lift in the economy as a whole. I don't expect that to happen this time. And the reason is because, first of all, mortgage owners today do not have an effective mortgage rate of 5% or 6%. It's closer to 3.5% or 4%. And so we'd have to see mortgage rates move much lower to see a boost. But also, housing is unaffordable. Prices haven't moved lower even as mortgage rates have been high for the last couple of years. That's a challenging environment. We'll see some changing of hands, but it's a challenging environment to see a real boost for the economy. And it's one of the the reasons why I expect, though growth is very strong, we'll see it slow closer to trend or just below trend here in the next quarter or two.
All right, Lauren, it's always great to see you, of course. That is Lauren Goodwin of New York Life Investments. Let's transition over to what's going on with UPS, of course, as we are in the heart of earnings season. You can see UPS shares, they're soaring, not as much as they were earlier, but that's after they returned to sales and profit growth for the first time in nearly 2 years. Let's dive into the results now with Lee Klasko. He is Bloomberg Intelligence Senior Logistics Analyst. And it's interestingly, of course, the headline there, returning to growth in the first time in 2 years. And with that in mind, you think about the rough year that UPS had. Is it fair to call this a relief rally?
Yeah, I think so. And I think it's showing that the stuff that they've been doing from a productivity standpoint is starting to pay off. That coupled with the fact that they're becoming more of a focused parcel carrier with the recent divestiture of its freight brokerage business, Coyote, to RXO, it just seems that things are going well for them, and they're just becoming a lot more productive, and they're expecting, their revenue per piece in their domestic business in the fourth quarter, that growth to outpace their cost per piece. And a lot of that is being driven by some of the pricing initiatives that they have, whether it's a peak surcharge, a peak season surcharge, or the fact that they're going to, price their product if they're harder to handle. So if it's not conveyable, so if it can't be automatically put through their system, they're going to charge a higher price for that because the additional cost that comes with it.
Now, one thing I'm wondering about UPS in particular is how sustainable these results are as well. You think about some of the demand coming from the Postal Service deal that they have as well. Can this type of performance now be repeatable now that we've seen the best numbers in 2 years?
We're pretty optimistic about UPS in the near and the long term. Like I said earlier, some of the productivity and cost initiatives that they have will really pay off when the economy, quote unquote, normalizes. Going into peak season, which is obviously the busiest season for the FedExes and the UPSs of the world, they're positioned pretty well. They did note that on their call that some of their customers are expecting a slightly less robust peak season. And that's really because of the condensed nature of the peak season. It's only 19 days between Black Friday and Christmas Eve. And we haven't seen that since around 2019. And so a lot of the retailers are saying that the customers might be more apt to go into the stores because of that condensed window to shop. But net, they do expect growth of their peak season this year versus next.
All right, Lee, thanks very much for joining us. Lee Klasko there from Bloomberg Intelligence. He runs our coverage of logistics, and UPS falls into that box. Those shares, again, up 5% almost, but they're down 16% year to date, or they were before today's trade. They're only up 15% over the last 5 years, and FedEx is up 74%, so a real underperformer for the men and women in brown. Coming up, Citi is starting to see the results of its restructuring plan. We'll speak with David Livingstone, Citi's Chief Client Officer, next. This is Bloomberg. Let's get now to high interest. A look at what's making headlines right now around the world. China is pressuring its automakers to pause expansion in the EU because of the escalating trade conflict over EVs. Bloomberg has learned that Beijing is telling manufacturers to put a hold on active searches for production sites in the region and the signing of new deals while negotiations over EU tariffs on Chinese EVs are ongoing. Meanwhile, Barclays is announcing third quarter results that topped estimates. The news offering hope that executives are delivering on their lofty promises to boost the bank's returns. It's a key win for the CEO, who kicked off a multi-year plan to turn around the British bank by plowing more cash into its UK operations and focusing on its investment bank. And new research suggests that patients taking Novo Nordisk's Ozempic were significantly reducing their risk of being diagnosed with Alzheimer's. For years, studies have tried to assess whether GLP-1s could help with that disease. Novo Nordisk is now in clinical trials to see if Ozempic can benefit patients who already suffer from Alzheimer's. I would sign up for that trial.
We're going to switch back to banking because Citigroup's traders posted their best third quarter performance in at least a decade. The results are seen as a win for the company's restructuring plan to improve competitiveness. We're going to talk about that business and many more over at Citi with David Livingstone, Citi Chief Client Officer. The client organization was created last year, works with all 5 of the organization's businesses. A lot of change, David, over at Citigroup. We want to focus on trading and markets for a moment here because it's a tough calculation for a bank. There's a ton of volatility in many of the asset classes your clients trade the most. But the question also becomes, how much capital do you want to put at play here? How much risk do you want to take on? What is the cost of winning in this business right now?
Well, good morning, Sonali. And it's an excellent question because it's one we face every day, but we primarily face it through the lens of what our clients need. So when you say capital and deployed against either our fixed income businesses, our equities business, foreign exchange, a very important business, it's about the activities that our clients are undertaking and where they need the most support from that market making and activity. As you say, the third quarter was a very strong quarter, particularly this year. I think our equities performance in derivatives and prime finances has followed a lot of our clients' activities there. And as you say, volatility, and particularly later in September, there was some very strong activity in our markets business as we disclosed at earnings last week.
You know, I also want to know what your clients are saying about what they expect heading into and out of the U.S. presidential election. You were talking about the equities business. Of course, a lot of excitement around that as IPOs and equity issuance comes back. But do you think many asset classes will get more choppy as we head into that November 5th date and out of it?
Well, we're very close, aren't we, to that November 5th date, and it's a critical question. But it's one where, in fact, as our clients look at what is going to be the differences in policy settings. And I was listening to your previous guest, Lauren, and she was saying, I think, some very sensible things around, well, actually, the outlook for rates and long-term rates may not be that different under both administrations, but there will likely be still sort of fiscal latitude in the U.S. economy, which is very important. And our clients around the world, I think if there's a theme that they're very focused on, which is more exposure to the U.S., and that's whether they're portfolio institutional investors or whether they're strategic investors, because of the growth, the differential growth outlook that the U.S. still represents.
I want to talk about private credit because Citi obviously has inked a big deal with Apollo to do business in that space. A lot of people at the time were questioning, you know, why can't Citi just do that in-house? Does it mean that there's some weakness in Citi's business or on Citi's bench? But we talked with Richard Farley from Kramer Levin, and he said, no, it's actually a fantastic partnership that will produce synergies. I guess that's some corporate talk. But what's your view on the private credit partnership and why other big banks may be doing this with private equity companies?
Well, Matt, the private credit markets, as we all know, have expanded hugely in the last 4 or 5 years and therefore represent a very significant pool of capital for our clients to access. And if they're doing that via us, I mean, our origination capability across the capital spectrum is very significant. But as you will know, banks can be somewhat constrained about their ability to hold lower quality corporate credits because of the RWA impost, and therefore finding private credit market access for those clients is really what's behind the program and arrangement that we announced with Apollo very recently. So rather than it being a sign of weakness, it's actually a sign of strength that we're confident that we can originate a significant volume of activity, as I said, across the spectrum, and that ability for Apollo to partner with us and to be there to be a participant in those credits is really what's behind that initiative that we announced. How
much more can we see private markets essentially come to the public through Citigroup?
Look, I think it's an area which we've identified as being one where that interface between public capital markets, private markets, and particularly the banking system and the big counterparties like Citi acting as that interface between them. We only see that heading in one direction, which is continued growth there.
David, I also want to acknowledge you are meeting with clients alongside the IMF World Bank meetings. And as we were just talking about, too, deal activity is coming back. That's part of why this partnership was inked in the first place. People are trading into November. What are the biggest concerns around clients around the globe here? Of course, Citigroup is known for being the most global of U.S. banks. What are they worried about?
So I think the first on the list is what's the passage of monetary policy around the world, and how does that land, and particularly in with the easing of rates as inflation, particularly developed market inflation, is brought more under control. But what is it really? What's the interplay with growth? And I think that is the big challenge that a lot of corporate clients around the world, and indeed the government clients, and we're meeting many of them here at IMF, as you said. And it's where does growth come from? And then if you get under that, you have to say, right, what's innovation? What's happening in labour markets? I don't think that the labour markets are, on average around the world, have settled post-COVID. There's still under utilisation of labour capacity. And productivity is an issue. Western Europe, innovation and productivity are high on the agenda. You saw the Draghi report recently. And it remains a concern. And so people, our big clients, are saying, OK, how against that economic backdrop, what are the steps that we need to make, strategic M&A, capital investment in different economies, and how do we pick up on the trends like the one I said, which is more capital flow into the US. So our international clients are very, very focused on how they can execute and how we can help them do that.
A very sober warning on growth indeed, but at least people are not talking about the election so much. David, we thank you for joining us, of course, in Washington. David Livingstone of Citigroup. Now, still ahead, there is another place election anxiety is weighing on consumers, and somehow that's Whirlpool. We're going to give you the details and social climbers next. This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Whirlpool is reporting better than expected earnings and reaffirming its full year sales forecast. The owner of Maytag, it did also say that sales were softer than anticipated, but it expects consumer sentiment to improve once the U.S. presidential election is over. Shares currently higher by almost 10%. Next up, Lending Club out with results that topped estimates for the third quarter. The news triggering some positive reactions and upgrades from Wall Street. You can see shares soaring right now, currently higher by about 17%. And finally, we have the Birkin bag maker Hermes seeing resilient demand for its pricey handbags. Its performance has managed to hold up. That's despite the broader luxury slowdown. Its most loyal customers are still splurging on its most expensive products. Of course, you can follow all the latest company buzz on TRE and Go on your Bloomberg terminal. Meanwhile, let's get a quick check of these markets. We're about an hour into the U.S. trading day, and still green across the board from the stock market to the bond market. You start, of course, with stocks right now. The S&P 500 higher by about 0.3%. Big tech is your leader, with Tesla out in a big way last night. The Nasdaq 100 currently higher by about 0.7%. The bond market, as we've been saying, pretty well behaved right now, down about 2 basis points on your 10-year Treasury yield. It's the absolute level that some people are starting to get concerned about, but of course, some of that panic coming out of the market today. Now coming up, the future of food delivery is close to arriving at your doorstep. We'll speak to Ali Kashani. He is the CEO of Serve Robotics next. This is Bloomberg. Well, delivery robots, they may soon be coming to a neighborhood near you. Serve Robotics is unveiling the company's newest NVIDIA-powered delivery vehicle, and 2,000 of the bots set to hit the streets for Uber Eats next year. Now, these bots, they can serve up to 4 large 16-inch pizza boxes. Joining us now for more, I'm pleased to say, we have Ali Kashani. He is the CEO of Serve Robotics. So, AI aside, I mean, these also, as I understand it, cost less to manufacture, and they can carry larger pizza boxes and other foods. So walk us through a little bit what this means for your bottom line. Of course, the rollout isn't until next year. How much of a boost are you expecting from these robots?
So, launching thousands of robots, which could be the largest autonomous fleet in the country, obviously is a big milestone. And it was important for us to get the robots ready for that. So this new generation robot is a couple of years of work in progress where they can move faster, they can go further, they can carry more, they are safer. And at the same time, they are actually cheaper to make, and they even have more AI capability, more, 5 times more compute. So there was a lot to do to get ready for this moment.
When we have coworkers in the Bloomberg building walking around with big boxes of pizza, I can smell it, and I kind of want to just knock them over and grab the box. Does anybody do that with the robots in your testing? Do you get a lot of interference?
I answer this question more than that happens. It's not that it doesn't, it's not very often. The robots are actually more reliable than couriers in terms of completing the deliveries. So they do pretty okay.
I still come down to what are the next markets, Ali, because, a lot of questions around safety, a lot of questions on how this would interact in cities. I mean, what are the hurdles you're looking to navigate as you expand?
It's really a question of, between us, our partners, where do we think is the most appropriate place to go next? There are some exciting things happening. We announced a partnership with Alphabet's Ring subsidiary, which is their drone division. We're going to do a pilot together in Dallas soon. I'm really excited about that. This is where the robots can do short distance deliveries, but when it's a long distance, they pick up the item from the restaurant and automatically hand it to a drone. So folks in Dallas can look forward to that. And then we're going to announce a few more expansions in the coming weeks and months.
I mean, it's fascinating. You think about, of course, drones flying around. Ideally, they would be able to come in through the window and I wouldn't have to move at all. But I want to talk a little bit about geography here. Of course, you announced plans for Dallas. But when you think about the makeup of certain cities, for example, Los Angeles versus Dallas versus New York, for example, if you have plans to expand there, is there a certain sort of type of geography that a city needs to have for a Serve robot to work there?
Well, look, where we are in LA is actually quite diverse. We deal with hills, for example. The robots had to be fitted with emergency braking so that if they ever lose power on a hill, they would just come to a full stop by themselves. So there was a lot of things we have already designed for. And generally, cities have one thing in common, which is restaurants are in concentrated, business areas, and there's a population nearby. So whether you're living in a smaller city or a major city, they all share that kind of, layout. So these robots can work in all those types of, environments. Now, we are not rushing to very difficult weather conditions where, half the year you're going to deal with ice and snow, for example. So we're gonna take small steps. But generally speaking, the robots are suitable for most conditions.
Can we just continue to show the video of the robot putting the package on the shelf and the drone picking it up? Because that's just incredible video.
TV.
Yeah, and while we show it, Ali, what are the regulations about this? Like, I feel like not only would I order this service, but I probably would order more food if a drone were delivering it to me. But I'm not sure if the regulators in Scarsdale would be super psyched about drones all over the place. So how do you deal with the regulatory aspect of it?
Yeah, well, drones are making good progress, obviously, but as far as the sidewalk robots goes, by default, they're actually allowed to operate anywhere in the country because there are no laws that ban them. And there's a reason for that. They're so much safer than most other transportations. They have 3,000 times less kinetic energy than a car. So every time we take a burrito out of a car and deliver it with a robot, we are actually making roads safer already, especially for pedestrians and people on bikes who are always at risk of, a car whose only job at that moment is to move a 2-pound burrito. So regulators have been very welcoming. We found them to be very open to this. 20+ states have put frameworks in favor of the robots proactively to encourage us to go there. So overall, it's been really, really positive.
I also want to talk about your relationship with other companies that are very much in the news right now, Ali, and that is NVIDIA and Uber. Both are counted as shareholders of Serve. What is your relationship like with them? At the end of the day, what does it mean for you to count them as such large shareholders and even partners?
Yeah, I think it's important to share a little bit of our history. So we started inside one of the largest delivery platforms in the country, which was Postmates, and then we were acquired by Uber. So we a few years ago we spun out of Uber. Uber has been one of our largest investors and shareholders and partners ever since. And since the early days, because we are working on bringing a new form of autonomy, we partnered with NVIDIA. We've been using their chips in the robots and learning about how to best use their technology. So they have been a really great partner and also one of our largest investors since. So it's a long partnership, but we are all pushing the envelope with what you're doing and hoping to continue doing that.
I know Matt already asked you about whether or not people attack these robots, but I have a different angle into that question. It's interesting to see, of course, you have eyes on these robots. They're pretty cute. You also have little names on them. I've seen Gemma and Jamie so far just watching the video. Is that to make them cuter to humans who are also on the sidewalk, to maybe sort of discourage them from attacking these guys?
That's absolutely right. Look, we are actually, interestingly, operating in Hollywood. Hollywood has made this a little bit challenging because there's such a dystopian view of robots and the future. At the same time, there's such an amazing opportunity when you're introducing robots to make sure they're fun, they're friendly, that when you see them on the sidewalk, you actually are excited to meet them and you have something to look forward to every day. So I think we've actually been quite successful at finding that right design language and the level of friendliness that makes these robots welcomed on the sidewalks.
It's a robots world. We're just living in it. Ali, we thank you so much. Of course, that is Ali Kashani of Serve Robotics. A lot of earnings today, guys. We're going to take a look at that now with Bloomberg's Abigail Doolittle. Abby.
Well, we are snapping a 3-day losing streak, at least right now. That S&P 500 up about 0.3%. We have crude oil down just a little bit. 10-year yield, it is down 3 basis points, taking a break from that tremendous backup over the last few days, up basically 60 basis points on the expectation that the Fed might not be cutting as much as had been anticipated. The dollar going down just a little bit. Speaking of bonds, Treasury volatility expected to stay on the rise given this uncertainty around the Fed. You can see here off of the 2024 lows, this is the MOVE index, that Bank of America bond index, rising. And of course, we have that Fed meeting coming up. So maybe it will keep going into that. As for some of the individual movers beneath the surface, let's take a look at some leaders and laggards. Tesla, of course, surging up 17%. They put up surprise growth, and investors now seem to want back in on this EV maker. UPS putting up growth too, up 5.1%. Trump Media and Technology taking a big down day, down 6.8%. This, of course, is one of the market's ways of voting on who they think will win the election in less than 2 weeks. This stock off of the recent bottom up more than 100%, but again, today down 7%. So a little bit of favor cooling there. And then finally, Boeing down 1.5%. The union deal, it was not ratified. They still want the defined pension plan. When Matt, a lot of experts, including George Ferguson and others, saying in this day and age, a defined benefit and pension plan, it's just very unlikely. So this strike might be going on longer than had seemed anticipated when they agreed on the 35% pay raise over 4 years. Yeah. A defined benefits pension plan is something that you typically now only see with, firefighters and cops, teachers maybe, but I guess if they want it and they're willing to sit out long enough, it's painful to Boeing, right? Because
that's the thing. And
it's painful to Boeing's clients.
Yes.
So they really need to get this done. They do have at least a competitor. Yeah. So I'm not sure that you're going to see American, for example, switch to Airbus, but they could. They could. But it is interesting, they do have the leverage here. You think about the union, and it is such an important point that even with that wage increase, 35%, sounds pretty good. It's certainly higher than 25%. But that pension point, I don't know how you resolve that. I don't know how either side really breaks here. So we're 6 weeks in. Who knows how long this could go?
It just shows you where you are. People don't say pensions anymore, but it tells you people are worried about what they're going to be living on later. And it is a big crisis.
And they're living so much later.
They certainly
And that's why pensions are so expensive. I feel like, they could get downgraded on their ratings now, if they don't resolve the strike. They could get downgraded if they offer a defined benefit pension.
I think a bit of a cynical view here on the airline industry as well. This is an oversupplied market. Is it so bad if certain planes are not flying? They need the pricing power.
The problem is we're flying on old planes.
Right. Very big problem.
That's a big problem. It's not just the absolute supply there. It also has ripple effects for Spirit AeroSystems. Let's also look at Tesla, though, because Tesla shares, we've been looking at them all morning, up 17%, you guys. That is the biggest one-day move since about April or so. So obviously, Tesla flying today. The Cybertruck actually pulled its weight. Well, it weighs 1 million pounds, so maybe not quite, but still.
I think it does pull its weight. Does it weigh? It's got to weigh about 9,000 pounds, I would guess.
It's super heavy. I wouldn't drive that on the
Speaking of pair trades, they were talking apparently about the ability to enter Texas in a bigger way for self-driving, and you see Uber actually now down about 2% today as well. So we've seen that trade, Uber versus Tesla, happening a lot this year.
All right, coming up, a story about the relationship between humans and artificial intelligence. Computer scientist and Nobel laureate in physics Geoffrey Hinton discusses the risks of AI.
I've got to correct myself.
Go ahead.
I mean, the Google machine tells me the Cybertruck only weighs 6,634 pounds.
It's lightweight.
That's pretty light compared to like a Hummer.
It needs Ozempic.
This is Bloomberg. All right, it's time now for our daily Wall Street Week conversation. And there's no doubt that generative AI is rapidly advancing. But how long until it is beyond human control? David Westin spoke with Nobel laureate in physics Geoffrey Hinton about the beginning of AI and its long-term risks.
Yes, it is very threatening, and I'm very worried about it. And we should definitely put huge effort right now into figuring out whether we can keep control of it.
What effort should we put forward? What should we do?
Okay, so for something like climate change, everybody knows what we should do. There's a very simple solution: just don't burn carbon. It's just we don't have the political will. We still give big subsidies to oil companies, which is lunatic. So we know what to do, we just won't do it. With AI, to keep AI safe from the long-term danger of more intelligent things than us just taking over from us, we don't even know what to do. Even if we did know what to do, people might not do it. But what we need to do now is, like in the early days of climate change, you had to establish that climate change was real. What we need to do now is understand that there really is this danger. These things really do understand, and they really are going to get smarter than us. But also, how are we going to keep control of them? We have some chance because we're creating them. Of course, when we create them, as soon as we make agents, which people are busy doing now, things that can act in the world, to make an effective agent, you have to give it the ability to create sub-goals. So if you want to get to Europe, you have a sub-goal of getting to an airport. And you don't have to sort of think about Europe while you're solving that sub-goal. That's why sub-goals are helpful. And these big AI systems create sub-goals. Now, the problem with that is, if you give something the ability to create sub-goals, it will quickly realize there's one particular sub-goal that's almost always useful. So if I have the goal of just getting more control over the world, that will help me achieve everything I want to achieve. So these things will realize that very quickly. Even if they've got no self-interest, they'll understand that if I get more control, I'm going to be better at doing what they want me to do. And so they will try and get more control. That's the beginning of a very slippery slope.
But that suggests time's a wasting, that in fact we don't have that much time.
We don't.
To be able to get some control over generative AI.
We control it right now, but we don't have that much time to figure out how we're going to stay in control when it's smarter than us.
How do we go about that? Let's take the United States, for example, but before we go globally, the United States, we have a government, there are good people in the government, smart people, some probably less
at present.
Smart. But are they up to the job of really understanding what you're talking about and getting their arms around it?
I think with the current government, they are taking it seriously. It's just very difficult to know what to do. One clear thing they should be doing, that I believe they should be doing, we need many of the smartest young researchers to be working on this problem, and we need them to have resources. Now, the government doesn't have the resources.
And that, of course, was David Weston speaking with Jeffrey Hinton. And you can catch Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg.
The latest Bloomberg News and Morning Consult poll shows the presidential race could hardly be tighter. It shows razor-thin margins in 7 key swing states with 49% support among among likely voters for each of the candidates. Joining us now is David Gura, host of Bloomberg's The Big Take podcast. This is not really news, David. I mean, this race has been tight for so long.
It is in many ways confirmation of what we have known. You know, it has gotten tighter than it was last month or the month before that. But yeah, within the margin of error, these are 2 candidates who are neck and neck, and you kind of pull it apart. The economy remains the biggest issue for voters by
according to polls, right?
margin.
Because betting markets tell a very different story.
Betting markets
we'll get there,
are their
right.
own world.
Yeah, but you know what? They're very different. So what's the one that foreigners can invest in?
Polymarket.
Polymarket. Obviously,
With
the
French
whales that we
whale.
talk about, right? But the predicted market doesn't allow whales. I think there's an $850 limit or
And that's
something
indicating
like that.
a victory for Trump.
Yeah, they both are.
Yeah. I'll speak to the poll, which came out this morning, and just indicate that we've seen Kamala Harris make up some ground on the issue of the economy and who might be able to handle it best. It's better than Joe Biden was when we were polling for him earlier in the year, but still she lags President Trump 50 to 45.
I want to also talk about kind of what is happening until the election. We had the town hall just last night, and we were kind of talking about that political playbook readout, the idea that she's starting to take more of President Biden's playbook as she heads into the final days of this election. What do you make of that, particularly as the issue around fears about fascism start to rise more lately around
This
Trump?
was like a signal moment in that town hall last night. Remember, this could have been a debate. CNN invited Donald Trump to participate, and he declined to do so. But we've had all of this reporting from The Atlantic and The New York Times based on interviews with John Kelly, the former White House Chief of Staff, former Secretary of Homeland Security, and 4-star Marine General, in which he unabashedly said that Donald Trump is a fascist. Kamala Harris was asked that last night. She said, yes, she does believe that to be true. One wonders who this is appealing to at this moment in time. I think there are plenty of people in the electorate who do agree with her on that point. Would undecided voters agree with it? Who's to say? But it's the strongest criticism that she's made. And again, to your point, what she's been trying to do in these recent days is to make the case that he would be an erratic and ineffective leader. And I think that's something we're going to see carry over here in the next 12 days.
Let's talk about what the potential cabinets could look like. Of course, Elon Musk on his earnings call was talking about maybe him being in Trump's government. You have the New York Times reporting that Jamie Dimon hasn't officially endorsed Kamala Harris, but would be open, of course, to having a role in her government. It's kind of fun to think about, you know, the different chess pieces here.
It is a wild parlor game, and we've seen Liz Cheney, the Republican, coming out in support of Kamala Harris. There's been some whispering that she might be involved in a Kamala Harris cabinet if she were to be elected. Elon Musk is a fascinating character in so many ways. I am skeptical that he would join a cabinet, but what Donald Trump has said over and over again is he would put him in some sort of position overseeing government spending and cuts to the government.
You had Kevin McCarthy on Bloomberg
Earlier
Surveillance with John Farrow and Anne-Marie Horduran basically saying that Elon Musk, people like him, would be great in government. So the Republican side absolutely seems open to it.
There is a lot of new affection for him among Republicans. He's going to speak at scheduled to speak at Donald Trump's rally at Madison Square Garden this weekend. Obviously, the Trump campaign sees him as a conduit to this pro-vote young men who might come out and support Donald Trump.
Marinate on this Dimon idea for a second,
Yes.
because the whole idea, if you're a Republican and you put a business leader into a cabinet position, you get the votes. If you're a Democrat, however, and you go for Jamie Dimon or even any of the other names, Blair Efron or Ray McGuire or Ken Chenault, you don't get the left. How could you ever see someone from Wall Street really being picked for a Harris cabinet?
I think that there's a possibility, but you're right. I think that just even in floating these names, you can imagine what the press releases from Elizabeth Warren and others would be like. Immediate. And so you've kind of seen that.
Elizabeth Warren is her own thing, isn't
True,
she?
but on the banking committee.
Is it really that important to go that far left?
No, but I think that you will get that criticism from that flank of the Democratic Party, certainly. And she, yeah, so I think that would happen. But you see that in the blowback there's been to that New York Times article. So this is a Rob Copeland piece that kind of floated this idea from sources who weren't named in that article. Look, I think that there's no secret that Jamie Dimon is somebody who is actively engaged with Washington, is often in Washington, has regular conversations with the Treasury Secretary.
He's a Democrat.
He's a Democrat. He is interested in supporting his country. He said that unabashedly as well. I do wonder if he could be confirmed or if it's something that he indeed would want. He seems very happy running the world's largest
Can you
bank.
confirm, can a Democrat confirm someone without Elizabeth Warren?
Yes.
Okay.
That's true.
All right, David Gura, we have to leave it there. 12 days to go. I'm
Yes,
sure
we'll
we'll
be
see.
back. I'll
We'll
be
see
back.
a lot of you. That is David Gura. He is the host of the Big Take podcast. You can find it on Apple, Spotify, wherever you get your podcasts. Meanwhile, let's take a quick check on markets here. We're giving up some gains, you guys. You take a look at the S&P 500. We're still higher. The color is still green, but it's only up about 0.1%. Big tech hanging on in a bigger way. Of course, it helps that you have Tesla having such a fantastic day, but the NASDAQ 100 only higher by about 0.5%. Of course, we know that all the action is under the hood right now.
4 major groups in the green, but still many still in the red. Materials, energy, industrials, all in the red on the day. So to your point, not a simple trade out there. Tesla is lifting a lot of boats.
Yeah, I'm actually watching bond yields, Shonali.
You
Maybe
are?
some of you is rubbing off
I could go home now.
on me. 420 on the 10-year, and I wonder if
You
we
just
see
wanted to say
that start to
420.
climb into, I love to say it, it's not 420 yet, you know, but the 10-year yield is at 420, and I wonder if you see that start to climb into the election.
Maybe we'll have a president by 420. We'll have to see. Coming up tomorrow on Open Interest, John Stoltzfus of Oppenheimer Asset Management joins us along with some other great guests.
Ooh, Christian saving.
This is Bloomberg.